And full year FY 2026 earnings conference call of Hinduja Global Solutions Limited. From the senior management, we have with us today Mr. Venkatesh Korla, Global Chief Executive Officer, HGS, Mr. Winsley Fernandez, Full-time Director, HGS and CEO of NXT Digital Media Business, and Mr. Mahesh Kumar Nutalapati, Global Chief Financial Officer. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anand Venugopal from Adfactors PR. Thank you, and over to you, Anand.
Thank you, Sagar. Good evening, everyone. We welcome you to the Q4 and full year FY 2026 earnings call of Hinduja Global Solutions Limited. Before we begin, I would like to highlight that some of the statements made during today's call may be forward-looking in nature. These statements involve risks and uncertainties, including those related to the company's future financial and operational performance. Additionally, in the unlikely event of a call drop during the conference, we will ensure the call is reconnected at the earliest. I now invite Venkatesh sir to deliver the opening remarks. Over to you, sir.
Thank you, Anand. Good evening. Thank you for joining us. I'm Venkatesh Korla, Global CEO of HGS. Let me start by putting the year in context for all of us. FY26 was a year of disciplined transformation for HGS, where we focused on strengthening the fundamentals, simplifying the business, and positioning ourselves for the next phase of growth. We made strong progress in how we go to market. Today, we are operating with a single integrated HGS value proposition, bringing together experience, platforms, and operations in a much more unified way. This is helping us stay more relevant to clients and sharper in our execution. We took clear actions to rationalize our cost base across real estate, technology, and infrastructure, which has helped us deliver around 200 basis points of margin improvement. While reported revenue growth has been modest due to a few client ramp downs, the underlying core business remains healthy and has been growing. Looking ahead, we are seeing improved momentum in pipeline and new client wins. We are reinventing the efficiencies, or we are reinvesting the efficiencies we have created into growth, building new sales capacity, expanding our offerings, and accelerating our AI-led solutions portfolio. We see a clear opportunity to support clients in moving from AI experimentation to real scaled adoption. Our positioning around intelligent experience, powered by our realized AI methodology, is resonating well because it combines technology with deep process expertise on the front line. This is already visible in client outcomes. For instance, in the UK, we have seen a strong turnaround with new contract wins, including public sector programs that integrate AI-led solutions with human expertise. Similar momentum is building across the US, Canada, and Australia markets as clients increasingly look for partners who can deliver measurable outcomes, not just technology. Overall, we believe we are now better aligned to where the market is headed, with a clearer strategy, a stronger pipeline, and a differentiated position in the mid-market. With that, let me turn to our financial performance for the year. Snapshot of HGS's financial performance, Q4 and full year FY 2026. In Q4, we delivered revenues of close to rupees 1,085 crores. Total income stood at rupees 1,255 crores, with EBITDA at rupees 197 crores, and margin at 15.7%. For the full year, revenue from operations was rupees 4,307 crores. Total income stood at 4,857 crores, with EBITDA of 649 crores and margins at 13.4%. Moving on to what are the growth drivers for HGS. And before that, in fact, I want to actually, if you go back to the previous slide, I want to actually talk about the fact that we are announcing a dividend, a final dividend of rupees 5 per equity share on par value of rupees 10 each has been recommended by the board for FY26, subject to the approval of the shareholders of the company at the AGM. Looking at the growth drivers for HGS, let's look at what's driving this business. It's a combination of structural shifts and execution. First, a key highlight for the year, new client acquisitions. FY26 has been our strongest year ever, with 79 new clients signed on across BPM and digital services. This is important because it gives us a much broader base for revenue growth in FY27 and beyond, as most of our growth comes through existing clients. Second, we are seeing good pipeline momentum across service lines. The quality of the pipeline has also improved. It's more outcome-led, more integrated, and more aligned to transformation deals. Our package solution strategy is becoming a real growth engine. We now have 8 new solutions in the market, including AM Lens for anti-money laundering, Loan Flow for loan management and processing, KYC Vision. These offerings are designed to solve very specific business problems with faster deployment cycles. Today, Agent X is moving from capability to scale. We now have 23 active customers and 21 AI assistants in production. Importantly, these are not pilots anymore. They are embedded into real workflows in client operations. We are seeing a shift towards multi-tower deals. Key clients are no longer looking at CX, digital, and data offerings separately. They increasingly want integrated transformation. This plays directly to our strength of being both a BPM and a digital business. We can bring these capabilities together faster instead of operating in silos. We are also investing in our FDE-led delivery model, which improves both scalability and efficiency and delivers value for our customers. That's a very important shift in how clients are approaching AI today. We are moving from proof of concept to proof of value, particularly through our 90-day programs. More clients are willing to commit to outcomes, and we are increasingly co-innovating with them through AI-led centers of excellence. Finally, we launched a new brand identity and positioning around intelligent experiences in March. This is being received very well in the market. So overall, a combination of strong pipeline, better conversion, scalable platforms, and deeper client engagement is driving our growth, and we see a bright future ahead. As for our client satisfaction, which is in the next slide for NPS, HGS ranks in the top quartile. I want to speak to you about the trajectory in our NPS. We have seen a significant improvement over the last few years as the transformation has taken hold. Today, our NPS is at 60, up 12 points year-over-year, and 68% of our clients are promoters. We now sit firmly in the top quartile of the industry benchmarks on client NPS. Importantly, this is not just a metric. We are seeing CSAT translate into business expansion with our existing clients, and this is exciting. It's not just the clients recognizing us for our hard work, it's the industry and the analysts. We have won a number of key awards in FY26. We have won several top awards from credible organizations across technology, people, and CSR. Solutions such as AM Lens, DaVinci, and teams like data analytics have been recognized for their innovative capabilities, reflecting our transformation towards being an intelligent experience partner. We were also GPTW certified in the US and Colombia during the year, showcasing the trust of our people during this transformation that we're going through. Go to the next slide. Now, how does our evolution into intelligent experience provider work? All of this really reflects a broader evolution of HGS. We are moving from being seen primarily as a CX service provider to become an intelligent experience partner. What this means in simple terms is that we are no longer just executing processes, we are designing and delivering outcomes across the entire experience value chain, be it customer experience, operations, or digital transformation. The shift is very intentional as it aligns with where clients' demand is going. If you step back and look at the market, we are at a very interesting inflection point. There's a lot of investment going into AI, but a large percentage of initiatives are getting stuck. Today, most pilots don't deliver ROI or fail to scale. Enterprises are realizing that they don't just need technology, they need a partner who can take ownership of outcomes and actually operationalize AI at scale. That's the gap we are focusing on solving. They're looking for a partner who can bridge the gap from promise to production. From looking at it from our perspective, this brings us into a very simple but important point. AI itself is no longer a differentiator. Almost everyone has access to similar tools. What really matters now is execution. How effectively can AI be embedded into real business processes and deliver measurable outcomes? This is where we deliver HGS value, and we believe HGS is an advantage for our customers. This advantage comes from our legacy of 50 plus years. We bring decades of experience across customer experience, system integration, data, and machine learning. So we are not approaching AI as something new. We are layering it on top of capabilities we have been building over many years. This always allows us to move faster and with more confidence. That positions us very well as the intelligent experience partner. We see our role to be someone who can connect technology, process management, and experience design to deliver real business outcomes. And increasingly, this is exactly what our clients are looking for. Now, looking at delivering intelligent experience with certainty, that's a bold promise. Considering today's competitive markets, the way we deliver is equally important. As part of our new approach, we focus on certainty of outcomes, not just activities or KPIs. Our model brings together intelligent platforms, intelligent operations, and intelligent interactions, all built on a unified foundation. So whether it's a automation of workflows, improving decision-making, or enhancing customer journeys, everything is designed to be measurable and embedded in real operations. I want to reiterate that it's not an overlay, but part of how the business runs today. Our capabilities to support this, we have been building and have built a very broad capability stack across AI, data, cloud, cybersecurity, and engineering, combined with strong domain services like customer service, finance, HR, and digital marketing. This allows us to work not just on isolated problems, but on end-to-end transformation programs for our customers. Leveraging these capabilities, here are some examples of what we have been able to do for our clients. We have been able to deliver real AI with real returns across marketing, sales, service operations, and compliance. For example, for a US-based medical device company, it just helped capture high-intent patient leads instantly through always-on AI engagement. We built a scalable, compliant, AI-powered CX layer that delivers consistent, empathetic interactions without adding more headcount. The results, 50+% of higher engagement, a 35 to 45% uplift in sales potential, and response times of under 5 seconds. Similarly, for a North American beauty brand, HGS built a forward-looking intelligence platform that spots market trends 4 to 8 weeks early. We streamlined research by automating 60 to 70% of effort, freeing analysts to focus on insights and strategic advisory. The result is a differentiated intelligence layer that brings together trend foresight and clear data-backed insights for faster, sharper decision-making. And how are we doing all of this? We are using a methodology called Realized AI. The core idea is very simple. The opportunity isn't more AI tools. It's AI that lives inside the workflows where every interaction becomes intelligence you can act on. Buyers today lack certainty. We are talking to executives who know they need to change but are unsure about how. Clients don't want bots that deflect. They want resolution. They don't want vendors that slap AI wrappers onto legacy platforms or pyramids or a digital patch. They want agentic ecosystems or a multi-agent workforce where humans provide oversight to AI agents. Basically, they want a partner who engineers intelligent experience with intent. So what is Realized AI? Realized AI is HGS's operating model for deploying AI in production, not experimentation. It's a risk that is shared and not transferred to the customer. We pick one client process, identify the problem, and solve it. And we take it from zero to production in 90 days. Once the client sees the value, it leads to more business for a longer term, and we scale the AI tooling that we build for the customers. The Realized AI model has 3 pillars. First, the team. HGS has almost 18,000 people with real operational experience with strong domain knowledge, not just technical expertise. These are people who have had thousands of conversations with customers, executed multiple paychecks, and people who can tell what the emotion is going to be when a customer does not get the answer they're looking for. People who know how to train hundreds of agents and onboard them over a few weeks. These are practitioners. Second, the method is a clear scientific model how we document the needs of the clients, build and deploy the technology, and measure outcomes using our FDE approach. And third, the AgentX workbench. Our accelerators and pre-built components allow us to move quickly and consistently. Together, this gives us both speed and reliability in execution. Here's a case study. Let me give you a real example in the UK public sector. We have deployed what we call as Case Assist, an AI-augmented solution for checklist preparation in adult social care. The process used before was manual and time-intensive and typically took over 4 hours per case. With our solution, it's now down to about 30 minutes with near zero rework. This is a significant improvement in both productivity and quality, but the real impact is on capacity. We have been able to onboard over 40 additional practitioners and help clear large backlogs that were impacting service delivery. Importantly, this isn't about replacing people. It's about enabling them to focus on judgment and decision making while AI handles the heavy lifting. So you get faster outcomes, better quality, and better support for the citizens who need it most. At this point, I want to hand over to Vince to talk about the media business as well.
Thank you, Venk. Good afternoon, good evening, everyone, and welcome to the call. I hope everyone can hear me loud and clear. In case my audio is not clear, can I request someone to point it out, please? Otherwise, I'm assuming Tanuja, or can you hear me, everyone?
Sir, your audio is coming through loud and clear.
Thank you very much. I'm going to go straight to slide 21, which is the management commentary on the media business. And I think a term that Venk used right in the beginning is very important, has been very important for us. We mentioned it last year, and the term is discipline. The entire year, FY 2026, has been a year of disciplined execution and a portfolio rebalancing for the entire media business. And clearly, there was the need for portfolio rebalancing. This was a question that was asked last year, that linear television is facing headwinds. We're seeing, whether it be cable television or hits or DTH or any other linear form, being impacted by transitions to OTT or to free-to-air services. And I think that has been a very important thing for us. And therefore, we have focused this year on rebalancing our portfolio and, of course, executing it through a very disciplined model. And while doing that, we have focused on ensuring that our broadband business, more specifically our retail broadband business, and Celeritics, which is our enterprise service, we've developed those as the engines of forward growth. They've continued to make significant impact, positive impact during the year. And as I said, we focused in terms of the digital television or DTV vertical to ensure structured cost optimization faced with challenges, as well as maintaining ARPUs, which is very important, or the average revenue per user. But I think the highlight of the last quarter has been the signing of a memorandum of understanding, or MOU, with the government of Uttar Pradesh for a project called Project Ganga. And if you go to slide number 22, this gives you a heads-up view, or gives you kind of 360-degree view on what is Project Ganga. So the State Transformation Commission of the government of Uttar Pradesh is tasked with looking at building a strong vision and mission for the state and executing it. And one very important thing is that there is a very, very clear digital inclusion goal set by the government of Uttar Pradesh for extending digital access to consumers and to communities without exception. So whether it's access to digital education or healthcare or remote work opportunities, even other services, right, whether it be governance services or others, there is a very clear digital inclusion goal of the state, especially in underconnected and rural communities. And Project Ganga is basically a large-scale digital inclusion initiative in the state to be able to provide that connectivity. And we're very proud, as in One OTT Entertainment Limited, our broadband vertical, for signing this memorandum of understanding in March for Project Ganga, which is Government-Assisted Network for Growth and Advancement. So what is actually Project Ganga when you look at it? So the objective is empowering youth, enabling as many as up to 10,000 entrepreneurs at the Nyaya Panchayat level. They have to be developed into independent digital service providers, or DSPs. One very important thing, which is a very clear mandate for us, is that it must include a significant number of women entrepreneurs, which is clearly the vision and mission of the state. And when the project is completed, over 2 million households across the state of Uttar Pradesh will get connected with high-speed broadband over the next 2 to 3 years. And to make the project really successful, the government has worked, has defined a model that each selected digital service provider will receive essentially an interest-free and collateral-free loan of up to rupees 5 lakhs. There's a very strong scheme that the government has called the Mukhyamantri Yuva Udyami Vikas Abhiyan, or CM Yuva scheme, under which they will receive this loan. So OIL, or the broadband vertical of Hinduja Global Solutions, is the effective enabler and knowledge partner. We will not only help facilitate the DSP identification, but also provide the requisite training in business operations and technology. And of course, we'll support, we'll bring all our experience, expertise of so many years, decades of setting up digital television, setting up networks across the country, and setting up broadband. We will bring all of that technology and experience to help the partners, the DSPs, with network design and as well as hand-holding. And while initially the services that the DSP will provide will be high-speed broadband, it will also expand to Wi-Fi connectivity for public areas, for schools, colleges, and other areas. There will be access to OTT platforms. There's IPTV that is lined up, and of course CCTV for homes, and connectivity for offices and establishments which come under enterprises. There's been a lot of positive feel good about it, and if you go to slide 23, you get a sense the amount of coverage that this has received, because it is indeed a unique project. Nothing of this scale has ever been done before, where over up to 10,000 entrepreneurs are being trained. The local entrepreneurs, they're being trained in digital schemes and effectively developing 100,000, strong parallel workforce of digital warriors. Because obviously, as you start digital services, you will need people who are attached with the business. That could include customer service executives, billing executives, linesmen who will have to draw the fiber. So in addition to the Project Ganga MOU that we signed on the 9th of March, if you move to the next slide, we also signed an MOU for digital skilling with the UP government to skill 100,000 youth in terms of digital skills. And this is something, again, that got a lot of traction, because our idea is that it's not just for 10,000 entrepreneurs, it's also creating a really strong, robust ecosystem of digital warriors that can help not just develop the broadband push, high-speed broadband push across the state, but all the parallel digital activities. And this is something that at AGS that we believe in. It's not just the inroad, but it's also the larger envelope of services that could be emerging technologies, whether it be cybersecurity or, as Venk was so rightly pointing out, artificial intelligence and other related services. All of these would eventually get enveloped within a digital skilling workflow going forward. So there's a lot of excitement on that. There's already a kickoff started, and we will keep you posted as the project progresses. Going to slide 25, and I apologize, I think there is some text missing on the pie charts here, but I will read it out to you anyways. If you look at slide 25, this is something that we've started sharing with you as analysts and investors and people who are interested in looking at how the business is really picking up. So one of the key KPIs is the value migration. And if you look at the two quarters, we've looked at last year where we were at this time and currently in 2026. And if you look at it very clearly, the upselling and packaging strategy of the company has certainly started to pay dividends. Because if you look at what we term as high-speed customers who are greater than, who pick up speeds greater than 100 Mbps, last year at this time, about 10.7% of our base, was pretty much in that segment. That has straight away jumped to 15%. So the quadrant that you're missing, the numbers on the right-hand side, the 101 to 200 Mbps should read as 9%. And the 51 to 100 Mbps is 38%, right? So, yeah. And like I said, the mid-level package also, if you look at the 51 to 100 Mbps, right? That has significantly jumped from 31% last year to 38% this year. So straight away, you're seeing a lot of traction, positive traction happening in that space to be able to grow. And more importantly, entry-level package. As the consumer base grows, we also want to see consumers who sign on for the first time or customers for the first time picking up higher base plans. So earlier, if you looked at the base plans, earlier the up to 50 Mbps, nearly 54% of our base was, which is the 10 to 30 that you're seeing, was about 21%. Was 28% last year. So 28% in 10 to 30 Mbps and 33% in the 31 to 50 Mbps in Q4 of FY25. If you look at the shift to this year, has been significant. From 54% last year, it's dropped to 46%. So more and more consumers are adopting a higher base plan at start. So it's not just reflecting the upselling and packaging strategy of the company, but also there is a clear sense of improved customer affordability, and there's rising data consumption. The apps that are coming out, the services that are coming out, they all require significantly high speeds, better bandwidth, less breaks, etc. And so very clearly, this is a reflection on slide 25. So with that, I'm going to go to slide 26, something that I share every quarter again. And as you can see, the two graphs on the left-hand side is our digital television business. Very, very, very clear that given the headwinds facing the industry and the challenges across the linear television industry, we're making sure that we're focusing on retaining our customers and therefore ensuring the churn is well below 2% in the last couple of quarters. And at the same time, ensuring that the ARPUs, the average revenue per user, remains stable at 122. So it shows the consumer obviously, happy with the package that she or him would be selecting. On the left-hand side, if you look at the churn, again, which is correlated, this is, again, a matter of great pride for us. The average churn in the industry is close to anywhere between 2 to 3% per month, and we've been able to see a significant control, kind of coming in at the end of Q4 at about 0.62%. So that shows also the improved quality of service that we've been providing, the response time from the consumer teams. And is it great? Well, the way I see it, I think there's always room for improvement, and we're working harder on that. At the same time, full credit to the back-end teams who have been able to do that. And similarly, the back-end teams, which are teams like the finance and operating and tech teams, have also been able to pull down the bandwidth cost as a percentage of revenue in the retail segment. We were at 28%, and I think this has been thanks to better utilization, better negotiations, better cost optimization. We've been able to bring that down from about 28% to 26%. So overall, clearly, as I'd said on slide 21 in the commentary, that broadband, retail, and the enterprise services, Celeritics, they've been developed in the last fiscal as the engines of forward growth. That is the driver for us, and that is also reflected in the highlight of Q4, which is the MOU for Project Ganga, or Government Assisted Network for Growth and Advancement, which will see significant traction in the broadband segment. And at the same time, ensuring that our DTV business, which is facing headwinds, we continue to ensure a structured cost optimization as well as maintaining ARPUs. So that has been the net effect of the year and the focus of the year in the year fiscal gone by. And with that, thank you all for listening to me patiently. And I'm going to hand over to Mahesh, who's our global CFO. Thank you again. Mahesh, over to you.
Thank you, Vince. Good afternoon, good evening, everyone. Hope I'm audible.
Loud and clear, Mahesh.
Thanks, Vince. So this is Mahesh Kumar Nukalapati, Global CFO, and I will be taking you all through HGS financial performance for the fourth quarter and full year of FY26. And as outlined by both Venk and Vince, FY26 is a year defined by disciplined execution and portfolio rebalancing and a clear pivot toward our intelligent experiences strategy. As we go through the financials, we will realize that FY26 has been a year which absorbed our legacy runoffs, while Q4 showed signs of early recovery and in a way positioning FY27 as a rebuild year. Over the next few slides, I will walk you through our consolidated results, balance sheet, cash flows, and the composition of our revenue across source, vertical, geography, and delivery. Moving on to slide 28, which talks about the consolidated performance for Q4 FY26 on a sequential basis and a year-on-year basis. Revenue from operations are around 1,085 crores, with operating expenses of 1,057 crores. The total other income stood at 170 crores. The total income, including the revenue from operations and total other income, comes to around 1,255 crores, with a total EBITDA of 197.1 crores. And on a percentage basis, it is 15.7% for the quarter. The sequential expansion reflects the operating leverage from our pipeline conversions and the disciplined cost actions that we took throughout the year, and which will be continuing in the next year as well, where we can see some impact of the cost still flowing through, incremental cost on account of the actions that we are taking flowing through FY27 of H1. And as you can see, Q4 results show sequential recovery in top line and margins. If you look at the core business, it remains stable when we adjust for runoffs. And I want to reiterate here that runoffs that we had in FY26 are non-recurring in nature. And on a positive side, these runoffs definitely help us in mitigating the client concentration risk. With the Q4 results, we can reasonably assure you all that all the cost discipline actions are materializing. And as Venk also mentioned, that we have seen an upside in the margins of around 200 basis points. Operations are definitely becoming more efficient, and we can say Q4 as more of a trend shift rather than a target achieved kind of a scenario. Moving on to slide 29, which talks about full year performance at the console level, and on a sequential basis also comparison is there. Revenue from operations is 4,307 crores, and operating expenses are at 4,208 crores, with a total other income of 549.7 crores. Considering that the total income comes to 4,857 crores, with a total EBITDA of 648 crores, at a percentage of 13.4. As mentioned earlier, I think FY26 definitely has been a year of disciplined execution. We have rebalanced the portfolios, expanded our digital and AI offerings, and exited the year with a strong margin profile than we entered it. With 79 new signings across BPM and digital, as Venk mentioned in his presentation as well, I feel this is the best year we ever had on new logos. And but these signings, we are definitely entering FY27 with meaningful revenue visibility. Headline numbers, though, are flat, but drivers are clearly understood. And we feel Q4 has been the first signal of stabilization. Moving on to slide number 30, which gives a snapshot of our balance sheet at the console level. Our financial position remains robust. Financial assets, which includes investments, loans given, and bank balances, continue to provide ample liquidity to fund both organic growth and as well as any strategic investments in AI, package solutions, and broadband built out, as outlined by both Venk and Vince in their respective presentations. We continue to operate from a position of financial strength. Net treasury and cash surplus is around INR 5,346 crores, which gives us enough flexibility for us to invest behind the realized AI framework and Project Ganga without compromising returns. Moving on to slide number 31, which talks about a brief of cash flows at the console level. FY26 cash flows has been a year of investments in both operations and as well as on strategic priorities. And on strategic priorities, capital was deployed in AI-led centers of excellence, package solutions, and the broadband and Celerity X expansions while maintaining a conservative leverage. The quality of our cash flows definitely gives us confidence in funding the next phase of growth from internal accruals. Moving on, the next slide, slide number 32, which is the revenue composition by source. Looking at the revenue composition by source, our mix continues to evolve in line with our intelligent experience strategy, with growing contributions from digital, data, AI, and platform-led engagements, alongside our core CX and BPM business. The core CX BPM business continues to be at 55%, whereas digital and media services are at 45% for full year FY26. And for quarter four, it was 58% for CX and digital and media services at 42%. This diversification is exactly what we set out to achieve. Higher margins, stickier digital revenue layered on top of resilient core. We expect this trend to accelerate in FY27 as the new 79 new signings ramp and AI assistants move from pilots to productions. Moving on, the next slide, slide number 33, which is operating revenue composition by vertical. Tech, media, and telecom continues to be a bigger vertical with 50% contribution coming in, BFSI is 18%, retail 17%, and public sector at 8%. The public sector momentum is definitely encouraging for us, anchored by UK and Canada public sector wins, and as Vince also mentioned about Project Ganga and the digital scaling MOUs. So these create definitely a multi-year revenue runway with a strong social impact alongside commercial returns. Moving on to slide number 34, which talks about operating revenue composition by origination. On origination, that is where the revenue is sold from. So we maintain a healthy mix across India, North America, UK, Europe, and Asia Pacific, contributing around 38% from India, 28% from North America, UK 13%, and others at around 12%. The geography spread continues to be a key competitive advantage and a natural hedge against any regional softness. Multi-tower deals combining digital data and experiences are increasingly being originated across geographies, and we expect this multi-region, multi-service platforms to be a meaningful growth vector in FY27. Moving on to slide 35, which talks about operating revenue composition by delivery. In delivery mix, we continue to leverage our global delivery footprint to optimize our client outcomes, cost efficiencies, and language coverage. If you look at it, FY26 delivery mix, India being the highest with 42% delivery happening from India, 19% from North America, and around 28% if we add US and Canada, and UK 10% with all public sector deliveries happening, with Philippines around 13%. Our India and offshore delivery centers, as I mentioned, remains a structural margin advantage for us, while onshore and nearshore deliveries being scaled selectively for regulated and high-touch engagements. To summarize, FY26 delivered around 4,307.4 crore in revenue, EBITDA of 648.6 crores at 13.4%, a stronger balance sheet, healthy cash, and a record year on new signings. With realized AI scaling package solutions live with clients and Project Ganga underway, we are entering FY27 with confidence and clear momentum. Looking forward, we definitely remain cautiously optimistic. Despite ongoing macro uncertainties and continued client caution in the near term, our high-quality pipeline, AI-driven differentiation, and disciplined execution position us to deliver steady improvements in growth and margins over time. Our priority remains driving sustainable, profitable growth with an unwavering focus on productivity, cost discipline, and capital efficiencies. With that, I will hand it back to the moderator. Thank you.
Thank you. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Your first question comes from the line of Samruddhi Bane with Yes Securities. Please go ahead.
Thank you for taking my question. The first question is regarding the Vinci is described as CX data lake and received industry recognition as well. What are its core use cases and how does it complement our other AI offerings?
Okay, let me take that. Da Vinci is a platform that we have created where we are able to pull information from all the customer interactions that we have on behalf of a brand into a centralized data lake, where we not only bring the metadata about a given call or a given chat or a text message or an interaction that is had, we are also able to bring information from call transcripts. We're able to bring information from email transcripts or email summarization using AI, bring it all together in one location, combine it with other metrics such as average handle time and quality of the call and things like that, which allows us to, number one, provide a way for customers to extract interaction insights, to understand what are the common call drivers, which call drivers are trending higher, where we are taking the most amount of time. It also identifies interactions that can be automated using AI. There's the second use case. Third use case is it provides a customer 360 or the 360-degree view of the end consumer who's making the call, so that we can actually help our human agents who are taking the calls to be able to be more empathetic and to be able to answer the questions more easily that the consumer has. So making them more efficient and effective in what they're trying to achieve and represent the brand more efficiently. These are the three use cases that we're seeing. And the fourth, of course, is a financial discipline use case, where it gives you the full operational visibility of exactly where the stress points are in the service we're delivering. That is the value of the data lake and the use cases that we're seeing.
Understood. And how does it complement?
Well, it complements, number one, to run our operations more efficiently. It allows us to move our existing operations, which are human-led, with customers where it is human-led, to actually show our customers where the value is in moving them to be more agentic in nature, and where we can actually deploy conversation AI or knowledge AI and identify where the inflection points are to drive value for the customers using AI. So it goes back to the whole principle of you don't use AI for the use of using technology. You use it to actually deliver value. And first, you need to know where to apply AI to deliver value. And this is the data lake actually allows you to identify those insights.
Okay, absolutely. My second question was regarding the case study on social care showed dramatic reductions in the checklist preparation time. Are there any similar deployments coming in other public sector agencies or geographies?
Yes, so that was with the first agency. Now that is being picked up, and we actually have we are working with multiple different agencies in the public sector, both in UK and in Canada, and we're also starting to see the needs coming up in the US, where we are talking to these agencies where they have a lots of different. And it's not just about healthcare case workers, right? It could also be any other cases that the citizens want from the government, and we're able to deploy this and help improve efficiencies for these public sector organizations.
Okay. Just a small doubt I had that as we are planning for the CapEx, and on the same time, we have announced dividend payout as well. So can you shed some light on this?
Mahesh, you want to take the question? Actually, could you repeat the question, please? Sorry, I missed the initial part of the question.
As we are planning for the capex, so we require funds, but on the same time we have declared dividend as well. So can you shed some light on this?
So see, last year we could not declare dividend. We are seeing improved performance, and as we have the company generating profitability this year through its deployed assets, and we're also trying to move towards this bright future. We think that with the improved performance and future outlook, we are recommending to declare dividends to share the value with the shareholders as well. And I think there's enough cash assets in the company that we're not concerned about shortage of funds as we go through the transformation. We see a bright future, and so we thought it's best to share the optimism and potential growth with the shareholders.
Sure. Thank you. Thank you so much for taking my question, and all the best.
Of course.
Thank you. The next question comes from Ranga Prasad, an investor. Please go ahead.
Good evening, everyone. At the outset, let me say that I'm very happy that the company has announced a dividend of rupees 5 per share. Hopefully, this signifies that the management sees the company returning to profitability sooner than later. I myself am very confident that this will happen at the corporate level. Although I'm concerned with the steep losses that the media and communication division is facing quarter after quarter. Just in the last one quarter, it declared a loss of 50 crores, and for the whole year, 175 crores. And this is in spite of all the many positive initiatives that Vince has talked about the company taking. So my question is, where do we go from here? I mean, after all these positive initiatives, if we are still faced with mounting losses, what steps can we take to mitigate these losses? Because only if the media division starts to perform can we expect the whole corporation to perform at the corporate level. So if you could throw some light on that as to what additional initiatives we could be taking to stem these losses, that would be helpful. My second thing is about Project Ganga. It appears to be a very, very ambitious project, and I'm sure it will have a great social impact. But my concern stems from the investment that this will entail, and if you can expect this to contribute to our profitability in any way. I would like some light to be thrown on this. Thank you.
Sure. Good evening, sir. Vince here. Wonderful having you. And thank you for that. Sir, as regards the numbers, I'm going to ask Rajiv, our Media Group CFO, to explain. Rajiv, I hope you're available on the call. You there?
Yeah.
Okay. So you can explain that in a moment. But first, let me just answer more from a strategy perspective. So, sir, you're absolutely right. We have been taking a whole bunch of initiatives. It is, it's not any secret that the pay TV business or the linear television business is facing significant headwinds. And rather than us sitting on our hands and, kind of bemoaning the industry, we've been very, very active in terms of doing several things. And like I said at the beginning, sir, for example, I'll give you, specifics. So Celeritics, which is the enterprise broadband business that we developed barely a year and a half ago, revenues have increased for the enterprise business by 2x in this year. And the total contract value, which is the TCV, has increased by 5x. What we've been trying to do in this last year is actually build in terms of engines of forward growth, and to see slowly but surely how do we recover the losses and the challenges faced by the linear television business. Is it happening? It's happening. Is it happening at a rapid pace? No, sir. That is the challenge we're facing. So that is something in terms of the numbers that Rajiv will share with you in a moment. But it has been disciplined execution. There's been structured cost optimization in this year, very significant cost optimization, whether it be our network operating costs, whether it be our content costs, whether it be our business operating costs. All of those have been brought under control, and Rajiv can just give you a flavor of that impact. So on your question on Project Ganga, as I mentioned on slide 22, sir, so the way the model works is our investment into the project is mainly in terms of our expertise, our knowledge, and our know-how. We will be focusing on providing and facilitating the identification, the training process, the hand-holding, and we'll support the DSPs with network design, right, in terms of the knowledge that we've imbibed over the last 10, 15, 20, 25 years. So the investment, the capital expenditure, all of that comes from the CM Yuva scheme, sir. The government has a Mukhyamantri Yuva Udyami Vikas Abhiyan. It's a CM Yuva scheme which provides a loan to a qualified or selected digital service provider for up to 5 lakhs, sir. So the way we structured the project is for that to be able to cover his cost of rolling out his network. So our model is very clear. We will continue to be an internet service provider, and obviously our investment is related to the people, the processes, the technology, the website, lending our expertise, for which we will work in the garb of an internet service provider, and therefore earning our revenues through an ISP model, sir. So effectively, the entire capital expenditure investments will be funded by the CM Yuva scheme, sir, while as we, in the capacity of an enabler and knowledge partner, will provide all the other aspects. That's on Project Ganga, sir. In terms of your relevant question on the losses, Rajiv, if I can request you to please step in, and then I'm happy in case if Mr. Prasad would like any further clarifications, happy to bring that in. But Rajiv, would you like to?
Yeah. So we're taking forward from what you said, we are taking several initiatives on both the fronts, which is the revenue optimization in terms of increasing our sales to enterprises, a lot of getting new clients on Salarytics, and also the product mix, which you showed in one of your slides, which Vince shared, where the bandwidth, we are increasing the product mix, the higher bandwidth being consumed by the customer. So that's where we are taking several initiatives on revenue front, revenue optimization, and at the same time we are taking a lot of initiatives on the cost optimization side, like the bandwidth cost as percentage of the revenue is coming down. So we are doing very, very hard negotiation with the telcos and the service providers so that our bandwidth cost, which is the key input cost for our broadband business, comes down. Similarly, on the DTV front, though it has been facing challenges in terms of the subscriber base across the industry coming down, however, we are negotiating very, very hard with the broadcasters. So that is giving us very, very good savings. Similarly, we are looking at our entire operations where the G&A, which is the general and administrative cost, we are looking very, very hard look and cutting down the cost wherever possible. And of course, Project Ganga should give us some kicker. So I hope we will continue the revenue optimization and the cost optimization path is to bring down the losses. Vince?
Okay.
Yeah. So So like I said, sir, that is exactly the reality. The headwinds are not new for the linear business. I mean, it's a reality what the industry is going through. And like I said, we will continue to do whatever it takes. And I believe initiatives like Celeritics, initiatives like Project Ganga, and of course the rapidly changing product mix is putting us on the right track, sir, which is why, as Mahesh and Venk pointed out rightly, that we can see light at the end of the tunnel, and therefore we're working towards that aspect, and hence in line with the strategy of the group, sir.
At this point in time, are you in any position to give us any timeline? Will it take? Do you expect it to take 1 year, 2 years, a few quarters, or you're not able to say that?
No, sir. I think from an internal perspective, we have a clear timeline. We have a clear process. If I may only request you, sir, this being the first quarter of the year, if you allow us to share, at the end of Q2, the traction that we've gained on Project Ganga as well as other initiatives like Celeritics, perhaps we'll be able to explain it in greater detail in terms of the timeline, sir.
Thank you very much, Arvind. Now, I'd like to just sign off with just one request to management. Please focus on the efficiency of capital, that is the return on capital employed. See, the investor is looking at it this way. The book value per share is 1,700 rupees. Even a reasonable return on that would ensure that we get about 170 crores per share as the EPS, which in turn would definitely show an upward momentum of the price in the market. Right now, our market price is 400 rupees a share as against 1,700 rupees book value. Clearly, the market is saying that there's going to be destruction of value. Please focus on that. I mean, just even a slight improvement will work wonders. With that, I'd like to say off. It's just a request to management to focus on the efficiency of capital employed. Thank you.
Thank you, sir. Thank you very much. We will look into that. So thank you, sir.
Thank you. The next question comes from the line of Navya Bansali with Varun Finstock Private Limited. Please go ahead.
Hi. I'd like to ask about the income tax addition case. Like, what is the update on that?
So, can you be specific which aspect that you're looking at on income tax?
Like there was a case currently regarding the merger of NXT Digital.
Okay. So you're referring to the GAR panel case that is first.
Yes.
So that is currently sub judice, and we have filed an appeal with Bombay High Court. And the next hearing is on 12th of June. So we'll be awaiting the outcome of the hearing. But currently, as is there in the public domain, we have contested against the direction given by the GAR panel, and the case is with Mumbai High Court.
Okay. I would like to ask one more question. We have an EPS minus EPS of 34.52. Could you please shed some light on that?
Yes, talking about the EPS of 34.52, the basic EPS which is reported in the publication page. Okay.
Yes.
So I think that is a straightforward calculation that we have done. I think the earnings that we have received for the year, for the full period, on a standalone basis is a negative 160 crores. On a standalone level, it is a negative 160 crores, and that's how the EPS has been derived. So as we mentioned, I think FY26 year has been a sort of a turnaround for a year for us. So we have been looking at various initiatives to ensure that the losses are minimized and we get into a territory of profit making. And that was the confidence that internally we have, and then we also expressed that to our board of directors, where a recommendation for a dividend payout also has happened. So yes, FY26, definitely we're looking at a negative EPS, but as we progress during the year in FY27 and the years to come with the strategic investments that we're making in AI-led deliveries and on the broadband side, on the Celeritics side, we definitely look that this negative EPS will go, and also as pointed out earlier, the capital allocation will also start playing results, and we can see an upside coming in.
Okay, thank you so much.
Thank you.
Thank you. Ladies and gentlemen, we will take this as our last question for today. I now hand the conference over to the management for closing remarks.
So Vince, go first, Mahesh, and then I'll close it.
Sure. Well, nothing to add from my side. I think thank you everyone for being there. It's been as Venk has pointed out and Mahesh has pointed out, there's a lot of faith, and more importantly, we're seeing a lot of traction across the entire businesses. And I speak for the media business in terms of aspects of Project Ganga and broadband really on the right accelerator mode. And thank you very much for joining in, and we look forward to the next quarter when we will have more to report in terms of the progress. Good day to everyone. Mahesh?
Thanks, Venks. I think nothing specific to add, but just to reiterate, our priority remains driving sustainable and profitable growth. With the focus on productivity, cost discipline, capital efficiencies, and we are quite optimistic as we look forward for FY27. Thank you, everyone. And with that, I will hand it over to Venk.
Thanks, Mahesh. Thanks, Vince. And thanks, everyone, for taking the time to join us today. As you all know, we are making progress, and we'll continue to make progress. We see a bright future that's coming up. As the company transitions into a more of a technology services provider that is focused both around both process improvement at the intersection of process management and technology services. We expect a bright future that is there, and we're continuing to drive towards that direction with our new platform, World Intelligent Experiences. I hope you all got to see the change in the brand, the tone of the direction of the company, and I like the direction it's going in. Look forward to working with each and every one of my team members to deliver the value to all the shareholders. Thank you again. Appreciate your time.
Thank you, all the members of the management. On behalf of Hinduja Global Solutions Limited, that concludes this conference. Thank you, everyone, for joining us, and you may now disconnect your lines. Thank you.
Thank you.
Thank you.